So what do you do now? Like it seems like the market rally has hit a wall.
So we have turned less cautious on our overall views on risk assets in recent weeks. We think the downside risk to the global economy has definitely diminished, but we're still trading equities from an underweight perspective, mainly concentrated in U.S. large cap. We still think there is more earnings downgrade to come from there, but we're a bit more constructive on other markets such as China and Europe, where we think the economy has a bit more cyclical room to run. We are warming up to duration. We're actually buyers of U.S. Treasury. We think the U.S. Fed hiking cycle probably nearing its end. And within credit, we have a preference for high quality credit, so investment grade.
Has the U.S. jobs report changed your thinking in any way? That maybe we won't see a soft landing and maybe there's just going to be, a no landing scenario and price pressures could actually pick up this year and possibly bring back the volatility that we saw last year. How do you see it?
Yeah, I think that's definitely the key risk. If we look at the kind of key question for this year is really the labor market dynamics in the U.S. And as you said, if we do see continued tightening in the labor market, could we continue to see that softening in wage inflation we have seen so far? So we think that is the key question that will determine the outlook of the U.S. economy.
Are we underestimating inflation generally coming into this year?
I think definitely we're seeing probably a pretty fast change in terms of market expectations. Last year we were a lot worried about inflation. This year people
disappeared in January?
Yes, exactly. But we do think that risk of still a very tight labor market that spill over into inflation is still there.
Some people are thinking this China rally, you're still constructive. I'm just wondering, is it time to take some profits off the table, just given what we've seen so far? Or are you seeing other kind of avenues of opportunities still?
So we're definitely seeing a bit of profit taking in the market. I think that's understandable given how far the market has run. But looking at fundamentals, we're definitely seeing more room for Chinese economy to recover. So we think that fundamental support is still there with more favorable growth dynamics, and also policy we think will remain easy, at least in the first half of this year.
Do I still play the China story in China, or are there other places I can do that?
I think Chinese equity is probably still the top choice, and we also note Asia actually has been lagging the rally so far, so maybe there's more opportunity there. But moving further into the year, maybe we could see more opportunities within the broader EM as we look into the other economies as well.